oh, you're going to crash because of it. It looks like the kind of thing that means, hey, I just snapped your leg in half, okay? And now you're crippled. And, once you get a few more entities that start to break, like Visa and MasterCard, as far as we're concerned, have broken major long-term momentum trends. Well, heck, everybody's looking at AI and look at it, NVIDIA stuck in the middle of this like 6-month range, just whip, blip, 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 nothing, But I can bet, you'd bet, that the Fed knows what's going on in the financial sector in terms of credit problems. And look, we know that the Fed back in November, Williams, I think is the head of the Fed in New York, Fed, made a statement that the Fed's going to start buying bonds. Still dirt cheap on silver, but technically that spread is broken out. Now, when you can plot that spread chart month to month, you get a technical picture. And we got a basing action spanning like almost a decade. We broke through that in November. That started the clock. By the way, in November, silver was $56, so it had just broken out of the range. We're watching sectors that other people don't watch so closely. Essential sectors, financials particular, and banks. Technically speaking, they are much weaker than the S&P. So while the S&P is firm against its recent highs, although congested, just below 7,000, the financials have slipped for a couple of months, broadly speaking. The financials, XLF, for example, which is an ETF that holds banks, insurance companies, broker-dealers, credit card companies, okay. It's deviated from the S&P in that its performance is credibly and measurably slipped, okay. Not in a way that creates thunder or screaming or anything like that, but just it's subtle. A very similar divergence occurred back in 2007 as the market was top. In 2007, we had a laborious price top in the S&P, and it made a high in the spring, like in May, dropped into the summer. So did the financial sector. Then the S&P turned around again, went back up near its highs, and then in September 2007, Federal Reserve had a surprise rate cut of 0.5 point. Oh boy, party on, okay? So the S&P moved to a new high in October, so literally a few weeks after that rate cut. That was it. That was top, okay. But they had a party. They went up and took out the old high, which happened to also be the same high as occurred in 2000. So the high in 2007 and the high in 2000 were around 1550 of the S&P. When they cut the rates, it blasted up into the 1576, I think was the high. So it took out all the highs on a happy surprise federal rate cut. Oh boy, they're on our side. If you sold that, you sold the top tick. But during that time, the financials had already slipped while the S&P had just congested. And then the S&P made a new high and the financials went up and made a anemic secondary high. Didn't get back to their highs. But they'd already broken, by our metrics, the financials had already broken their major momentum trend, which the S&P had not done at that point. So in other words, you had an early warning from the financials that wasn't like a table pounder, wasn't headlines, although later it would be, as we all know. But it warned you. And we're getting the same kind of behavior right now out of financials and a couple banks even that are breaking what we consider to be major momentum support levels. Now, it's not the kind of thing that looks like, oh, you're going to crash because of it. It looks like the kind of thing that means, hey, I just snapped your leg in half, okay? And now you're crippled. And, once you get a few more entities that start to break, like Visa and MasterCard, as far as we're concerned, have broken major long-term momentum trends. Well, heck, everybody's looking at AI and look at it, NVIDIA stuck in the middle of this like 6-month range, just blip, 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 nothing,
The current market environment is beginning to resemble patterns seen before the 2008 global financial crisis. In 2007, financial stocks weakened months before the broader market collapsed. Even as the S&P 500 pushed toward new highs after a surprise interest rate cut from the Federal Reserve, banks were already showing signs of distress. That divergence turned out to be an early warning. Today, analysts observe a similar situation developing. The broader market remains relatively stable while the financial sector shows structural weakness. This pattern does not guarantee a crash, but historically it has served as a critical signal that something deeper within the financial system may be breaking down.
No fear or alarm there. Whereas the financials are breaking stuff. And yet nobody's noticing because there's no headlines yet. But I can bet, you'd bet, that the Fed knows what's going on in the financial sector in terms of credit problems. And look, we know that the Fed back in November, Williams, I think, is the head of the Fed of New York Fed, made a statement that the Fed's going to start buying bonds. His excuse was, not that we need to support that market, but because we just need to provide liquidity. Isn't that cute? Okay. Since then, bonds have dropped in price, risen in yield, and recently they rallied in price, dropped a bit in yield over the last week or so, but basically have gone nowhere since November when they started buying them. In fact, it was price level right now of T-bond futures. It's where it was then. So they really haven't been able to cause that market to rally or the yields to pull back on the long end. And therefore, that long-dated debt is choking a lot of people who have to pay. And this impacts the banks, of course. And that's probably why we're seeing things like, we all hear the stories about people late on their credit cards, for example. Chart a MasterCard and Visa, especially our momentum charts, and you'll realize, something's broken here. But nobody's talking about it. And we like that. We don't want to have headlines. You don't want a headline to justify a downturn. You want the downturn, and then you look back and say, oh, golly, now I know why. If that's the way it works. But anyway, that's what's going on in the stock market. And meanwhile, the monetary metals have continued in a violent way, more violent than before, their uptrend. And yeah, we just had a sell-off because a lot of idiots came in and bought silver, gap up on Monday morning, and gold, and got hammered. Our experience with war news is if the market is already in a negative trend, definitely sell it. Okay. This is what happened back with crude oil. Remember back in June when we bombed the nuke site in Iran? I say we, I mean when Trump bombed the nuke site in Iran. The spiked oil up into the mid-70s. And if you bought that rally, and at that point in time, our assessment of oil was still not broken out to a positive trend. It was still a negative situation. And they slammed it. Within months, you were back in the mid-50s. So if you bought war news, you got bagged. Well, if a market is in an uptrend, silver and gold are. As far as we're concerned, oil went into an uptrend back in January when it crossed 63. And you get a newsy story like that, don't count on it holding. You're likely to suck in a lot of headline-chasing buyers, vulnerable people. And so when they buy high, expect them to get kicked in the gut. In the current situation, though, silver and gold, for example, they're already in an uptrend. We know that. Okay. So they got kicked in the gut, but it didn't in any way threaten the uptrend in gold and silver. It's just a sharp pullback from the high we made on Monday. And frankly, I think where we are right now, as you and I are talking, is probably about where the low is going to be. It was just below 80 today. It's now 83, 84 on silver, for example. I think probably in here, if you see it gel here for a day or two, that's it. It's over. All you did is bag the headline chasers. News stories like war, that's not what's driving gold and silver anyway. It's an underlying major fundamental financial factors that are in play, monetary excess that's ongoing. Now we have vulnerability, we argue, in the financial sector that's likely to show itself in the coming couple quarters, later this year especially. And I think the monetary metals know that. That's what's been driving them. They don't need war news. And anyway, so the people that bought the war news got gut kicked. Good. Anyway, that's what we see.
Another pressure point is emerging in the global bond market. Despite efforts by the Federal Reserve to stabilize financial conditions, long-term government bond prices have struggled to recover while yields remain elevated. Rising yields increase borrowing costs across the economy, placing stress on corporations, governments, and consumers alike. Similar problems are appearing in other countries, particularly in Japan and parts of Europe, where governments face enormous debt obligations. If central banks respond by expanding money supply or purchasing bonds to stabilize markets, the long-term effect could be currency debasement. Historically, periods of aggressive monetary intervention often push investors toward alternative stores of value.
I think most of the move to a new reality in silver is going to occur in the next handful of months, by summer. Okay. Now, there may be some after that, but the main goal is to get to the new reality. What do I mean by that? If you get a chart of copper, in fact, you can go to the Federal Reserve of St. Louis and type in copper, and they'll give you a chart going back to the 1980s or something. Look at that. You'll see that for decades, copper lived in a range from half a buck to $1.50 a pound. Decades of this up and down. That was its reality, okay? And in 2005, late that year, copper broke out of that range on its own. It didn't have help from gold or silver or even other base metals. And it went up quadrupled in a matter of several quarters. Went up to 450, okay? Boom, a new reality. And yeah, there were sharp sell-offs after that rally high, but the reality that then occurred over the next decades, the next 20 years, was basically either side of $4 as opposed to either side of $1, okay? So copper moved to a new reality, and it did it quickly, which when it broke out of that price range, the $1.50 to 50 cent in late 2005, it didn't go to the new reality over 3 years. And which is the new reality in the next couple of quarters, okay? And the exact same thing happened to lead back in 2007, where it had been in an old reality. Talking about lead, you can get that chart on the Federal Reserve too. And when it broke out in 2007, it went up like quadrupled in a couple of quarters and then lived in a new reality. How come silver was stuck in a half-century range? $4 to 50, $4 to 50, when those two base metals didn't. Gold didn't. Its mama market, made a high at $200, then it made a high at 850, then it made a high at 1920. So all those new highs in gold that were dramatically above the prior highs, silver was still capped at 50. What's going on? Well, that ended. Our momentum work told us that was going to end a year ago. We could tell, okay, we're coming up out of here now. We're going to blow through that nonsense, the idiot level, we called it. Because any idiot with the price chart could see $50, and thought that was, that was it. You couldn't go through there. And when we did, we gushed. We got up, into the mid-90s, and they had some congestion and sell-offs, and then finally 122 was the top trade in January. And in 1.5 trading days, literally 1.5 trading days, the tail end of January, silver collapsed down big time to 70 and ultimately got down in the high 60s. And then all during February, after that January 31st, February 3rd price low, 1.5 days, okay, silver congested above that level and built a base. We shot up out of that base based on our works a couple weeks ago, and price shot up into the mid-90s recently, upper 90s, I think, early this week. And up out of that basing action, then with this headline story where you sucked in a lot of, hey, I want some too, they got bagged. And you pull back about into the middle of that price range, the basing period that occurred all during February. Our weekly momentum, though, pulled back to the top end of that basing action. So momentum showed a slightly different picture than price. Price went back down below the recent highs, which were in the low 90s of the basing period in February. Got down into the, under 80 even. Now we're 83, 84. But momentum sat back on top of those highs when you plotted a momentum chart. So, as far as we're concerned, okay, this pullback was to a kosher area. It's okay. If you see any stability here, like today we got some, you see some more tomorrow, assume that was it. Okay. Same assessment with gold, except it's a little firmer than silver of late. Generally, it's been weaker than gold over the last year. But there's some other things going on out there. One of the things that told us also that we're going to have this move to a new reality was the spread relationship between silver and gold. In other words, when you divide an ounce of silver into an ounce of gold, express that as a percent. And back in 2024, 25, silver, I think early last year, silver got down to 1% the price of an ounce of gold. Well, think about that. Okay. What does that mean? Well, if you go back and look at that 50-year range in price, where silver went up to 50 and 50, the two prior times that it went up to 50, here's where that spread was: 6.5% ounce of silver versus gold. And in 2011, it was 3.1%. We got down to 1. I mean, it's like silver's free relative to the mama metal. Well, our argument is not only is silver likely to go to a new price reality, but it's likely to retest or challenge or even take out the old relative performance reality it proved to have in 1980 at 6.5% of gold, and in 2011 at 3.1. Right now, we're about halfway there, 1.6 area percent of gold. Still dirt cheap on silver, but technically that spread is broken out. Now, when you can plot that spread chart month to month, you get a technical picture. And we got a basing action spanning like almost a decade. We broke through that in November. That started the clock. By the way, in November, silver was $56. So it had just broken out of the range, of the price range. And at that point, the silver spread just broke out of a basing action. And we find that whenever that spread breaks out, like it did in 79, just prior to the explosion to 1980, and it did in 2010, prior to the explosion in 2011, that spread told you something is engaged.
During periods of uncertainty, gold and silver often attract renewed attention. Recently, both metals have experienced sharp price swings following geopolitical headlines, including conflicts in the Middle East. However, analysts argue that war news is not the true driver behind the rally. Instead, the long-term momentum in precious metals appears linked to structural financial risks and expanding global liquidity. Short-term traders frequently chase dramatic news events, which can trigger sudden price spikes and corrections. Yet despite temporary pullbacks, the overall trend for precious metals remains upward, suggesting that deeper macroeconomic forces, rather than headlines, are shaping the long-term direction of these markets.
And sure enough, we went from $56 at November close to an intraday high of 122 in 2 months. 2 months, okay? And you get a pullback now, we're 84, okay? But you're still well above that $56 breakout level on the spread of November. Also, we find that when that spread breaks out, it tends to gush, not just the spread itself, the performance of silver, but the net price of silver tends to gush for a couple quarters. We're only in month 3 post the breakout, just starting month 3. We suspect this surge is likely to continue for a handful of more months, 3, maybe 4, to keep the norm of what it does in the past. And so there's a lot of factors in play here that tell us silver's in a gush. Ignore the recent break, because in each of those prior surges that we had, 1980 and 2011, there was a point in the middle of that time frame, that like couple quarter surge, where you had a bad month. And it looked like, oh gosh, that was it. And it wasn't, okay? So that's where we are. A lot of factors are telling us silver is engaged versus gold. Not only is it engaged in price, it's engaged in relative performance status. And then there's another new technical we're going to talk about in a minute. That's the mimers.
I appreciate that, Michael. And I actually want to keep you here still for a little bit on silver, because it's very clear from what I'm hearing that there's been a jiggle, which you've also talked about. It's not going to go all the way straight up. Pullback was super healthy, super normal. But your point is that the momentum is still screaming, and that you see that there's still legs up for a powerful move. So I would love to hear what we have to see. If you could walk us through what we have to see for it to go past towards 3 digits. So let's say above 100, and what it has to do to get towards maybe going to 300 and then $500 silver.
Yeah. Well, there's also the monetary factor. If you're just dumb and you say, well, what's the monetary degradation? You go look at an M2 chart, and you go back to 1980, how much money was in circulation, M2 monetary, measure. And in 2011, and compare that to where monetary growth is now compared to those time periods. How much is the money supply doubled, tripled, And if silver were to simply match the growth of the decay in the value of the money, or the increase in supply of the money, it'd be $300 to $500 just to match that. So that's another factor that you got to look at. That's it's a glacial factor. It's not a timing factor, but it's just a fact of reality that silver is vastly underappreciated, undervalued relative to what it's selling for. Whereas gold has continued to go higher. Each of its bull moves are eightfold dimension moves from bear low to bull high, bear low to bull high, new highs each time, eightfold. Well, if we have an eightfold move in gold, we started from 1,050 in 2015, would be $8,400 gold. Okay. And by the way, we've been saying that for like a year, that's not our target. That's just noting a past reality. You have another eightfold move, big deal. You had two of them, have a third one. Okay. JP Morgan and I think Morgan Stanley both come out with reports suggesting something along that line based on fundamental factors. So we find that interesting. Maybe they're reading our reports. I don't know. Anyway, so if gold went to 8,000, think about that. And silver said, well, I'm going to go back to my spread relationship high that I had in, let's say, just 2011. That was 3.1%. Well, what's 3% of 8,000? Like $240. Yeah, and if I'm 6%, 6+%, like it was in 1980. In fact, for a period of time there, it wasn't just that spike. You were well above 6% for like a whole year or so. Good grief. That's assuming gold only matches its prior bull market dimensions. The 1980 peak and the 2011 peak were both eightfold gains. I don't think it's going to stop there because the factors we also talked about earlier, the financial sector and stuff like that, that stuff hasn't even started to unfold in a way that people get aware of, and the Fed is fully aware of, And therefore, the monetary panic that you could expect from them, they haven't even unleashed it yet. And you can bet by mid-May, if not before, the Fed's going to start cutting because they'll have excuses. Like phone calls from the big banks, hey guys, cut those rates, okay? But we suggested in the weekend report that frankly, any of these things that we see through our momentum work about specific big banks that are sitting on death lines, in other words, on momentum structures that if you slip just a bit, you're going to start cracking massive momentum structures. One of the major banks already has, I won't mention its name. And two or three others are sitting on structures like that, where when you break those, that's it. It's over. You're going to start down in a more serious manner, not a crash, but that's when the Fed, while they won't admit it in public statements, will wake up and start cutting. And they'll have some excuse like, well, I don't know, whatever. They'll find an excuse, one of their two mandates. But the real concern is they can't allow any kind of story to come out of the big banks. Remember a couple of years ago, we had the crisis in the middle scale and small scale banks. Yeah. Remember 23, there was we heard stories about that. It spooked people. You can't have that in the bigger banks. And right now, technically, they look vulnerable. So maybe even Powell, he goes out in mid-May, will have a story that forces him, not because he wants to accommodate Trump, because he doesn't want his legacy to look bad. Like he didn't cut and look what he did. Banks started. You get the point. What Trump would say if that happened, that Powell might, just to save his legacy, begin to cut in a quote surprise way. Again, not because of unemployment, not because of inflation, but because of this other factor. And I think gold and silver know that.
Right, Michael. Well, I appreciate you explaining all that because it's very evident now that this is holding and going much higher in terms of like the short term of 3 to 4 months from here.
Yeah.
And I know you're not the only one. I know Eric Sprott is talking about this. He talks about M2. I also know that many other technical analysts that I respect Chris Vermeulen, Christopher Aaron, they're saying that as well. Their time frames may be a little bit different, but they're also predicting similar prices to you. And on top of that too, we haven't even spoken about even like the gold to silver ratio in terms of it's still super high, and over the next couple of years, it's going to get tighter and tighter and lower.
We measured it on a percent scale, so this percent will get higher. Yeah, I understand that. I think that will be a big factor. Yeah.
For decades, silver traded within a relatively narrow range between roughly $4 and $50 per ounce. But recent market activity suggests the metal may be entering a completely new valuation phase. Historically, commodities such as copper have experienced similar moments where prices break out of long-term ranges and rapidly establish a new trading reality. Silver's recent surge past historic resistance levels indicates a comparable transition may be underway. Analysts note that silver remains inexpensive compared with gold, based on the gold-to-silver ratio. If that relationship begins to normalize while gold prices continue rising, silver could experience some of the most dramatic gains within the precious metals sector.
Yeah, there already is. Yeah. Those dynamics, the other market dynamics, like if the stock market breaks, especially the financial sector, Fed doesn't care about AI, but they care about the banks, okay, and the credit card companies and, et cetera, the financial sector. And if that starts to show vulnerability, and technically we see that, our opinion is S&P's have not made its high yet. Okay, now how do we factor that in and be bearish? I think it'll be a desperate last spike high. And I bet during that time, you won't see the financials do the same thing. So in effect, you get the same type of divergence you had in 2007, which was a big tap on the shoulder. Hey, something's wrong here. Okay. The Fed will be acutely aware of that. And that's what drives the monetary metals, the degradation in the money unit. And I don't mean to just mean here. Then there's another market factor, not just the stock market's going down. Bonds, government bonds. Government debt paper, not mortgages like in 2007 and 9. This family, that family, talking about government bonds. And they're sick. They've not been influenced by lower rate cuts in 90-day T-bills or something. It doesn't influence them at all. Long-term yields have stayed glued to a ceiling at very high levels. And we watch 30-year T-bond futures. Well, we know there's been a bond crisis in Japan. And they've got the same problem we do, except theirs is now more forefront. And their new prime minister, what's her name? But she is like the Trump of Japan and declared herself to be that. She says, we're going to print. I love it. You know, supposed free market president or prime minister there saying we're going to print. Oh, great. Have no respect for the value of money. Okay. And Trump wants to print. So all you have to have is an excuse. And they've been going ape over there to print, to save their bond market. Well, what if that contagion goes to us too? Because our bond market looks technically very bad. It looks like it's laying comatose on the floor. Remember, T-bond prices collapsed 2020 to 2022. We called it back in October 20. T-bond prices collapsed, yields exploded. And if you go back to October of 2022, when the collapse ended, T-bond futures were at 117. Where are they right now? 117. They haven't been able to get off the floor. They do this, comatose, trying to rally, trying to get rates down. It doesn't work. It can't sustain a rally. The bond market is anemic to the point where the Fed now has to buy it, print money to buy it. I mean, that's a crisis in the making. And we're not the only country. There's Japan, there's us, there's a couple of European countries, there's the UK. They all have government bond problems. Those are the kind of problems when they come to the forefront. Whoa. I mean, that's a bigger asset category than the stock market. Okay. Those are power forces to help gold and silver go ape because of the monetary degradation that central banks will have to engage in order to defend their paper. So these are factors that we're watching as well. The U.S. bond market, the foreign bond markets, the stock market. Because when these guys start to break, and I think they're going to break this year hard, and I think we've been topping effectively in the S&P since last year this time. We're at 6,200 then in February, just short of 6,200. Right now we're trading 6,700. Oh, big deal, okay? But it's still a topping process from our vantage point. I think that once it shows that it was stopping and alarms people, where are they going to put their money? It's never the case. You go back through history, 29 to 32, 73 to 74 in the stock market, 2000, 2002, 2007 to 2009. Stock market collapses. The gold collapse? No. There's always an alternative to the stock market, and usually it's the monetary metals. Oh, they'll have zigzags in sync with the stock market here and there, but their trend can be totally opposite. And I think that's what it's about to occur. In which case, even more money flow of fleeing assets from bad categories go into the monetary metals because, golly, now I feel safe. You know, I own what I would really call cash. You know, so when you take profits, put it in cash. That's called gold bullion. Okay. But anyway, those factors have not yet engaged. We think they're going to engage. And once that happens, that's when the headlines start. And that's when all of a sudden people say, golly, gee, I got to buy some gold. You know, the Western world's way behind on that issue, or silver. And I think silver is the one that's the most severely discounted, and its spread says so. It says, I'm cheap as heck. I'm going to catch up to gold and go back to more normal reality, a new reality. And then comes the issue of the miners. And boy, we got something there.
So let's talk about that then, the miners.
Okay, the miners, there's a chart, if you can show it. It'll smack people in the face, and I'll explain what they're looking at there.
Throughout financial history, major market declines rarely impact every asset class equally. During stock market collapses, such as the dot-com bubble and the 2008 global financial crisis, precious metals often moved in the opposite direction. When investors lose confidence in stocks, bonds, or currencies, they frequently seek protection in tangible assets like gold and silver. Today, with rising debt levels, strained bond markets, and potential weakness in the banking sector, some analysts believe the stage is being set for another powerful shift in capital flows. If these pressures intensify, precious metals could emerge as one of the primary beneficiaries of the next financial cycle.